For a look at what's ahead on this last trading day of the week, let's bring in Lisa Erickson, head of Traditional Investments Group at U.S. Bank, and Greg Branch is managing partner at Veritas Financial. It's good to see both of you this morning. Welcome. Lisa, what do you think about where we are right now? Are we closer to the top, do you think, or do we have some room to go?
Well, we're still moderately optimistic on U.S. equities, and really the reason why is if you look at what's going on from a macroeconomic standpoint, as well as with corporate earnings, we really still have very positive trend and momentum. We see most of our economic indicators with very good numbers and, again, continued momentum in them. And certainly second quarter earnings season was very robust. So that sets the potential foundation for some nice numbers through the end of the year. I do say moderately, however, because we do recognize that there's some risk and tests coming up in the second half where inflation may go, and also just higher base comparisons from last year that really make it harder for growth to beat. But overall, we're advocating for clients to stay in that U.S. equity position.
Greg, it seems to me that you're pretty worried about inflation. Is that right?
Yeah, I think that's a fair characterization. And more than just inflation, I think that we're going to see an opportunity to pick up some assets cheaper than we are now on the other side of Jackson Hole. The last remaining defense of its posture that the Fed has used is concern over what the Delta variant would do to the labor market. But the jobless claims numbers over the last 2 weeks kind of dismissed that narrative. We've seen pandemic low numbers the last 2 weeks. Only in June and July have we seen a couple of prints that's less than that. And so we've demonstrated that the Delta variant isn't causing any deterioration in the labor market, and quite the opposite. We have 10 million job openings. That's a record. We have 1 million more openings than we have people who are looking for work or underemployed. And so the Fed's position that we need to keep the foot on the gas with monetary stimulus, I think has been all but dismissed at this point, and I think that you'll see them start to change posture at Jackson Hole.
Yeah, the market doesn't seem too concerned about that, though, Greg, right? I mean, yes, inflation reads have ticked up. Some of the things you said, the Fed speak's been more hawkish this week. Melissa just said coming into this segment, we've hit record highs like each of the last 3 days. So the market doesn't seem to care about what you're worried about.
That's fair. And remember, I also believe that we'll see a tremendous third quarter. We had 85% of companies beat in the second quarter, and I think we'll see something of the same in the third quarter. But in the meantime, from here to there, I'll point you to different data in the market. The 10-year yield has gone from 1.15 on August 2nd, a low we hadn't seen since about February, to now around 1.36. So I think that the fixed income market is starting to anticipate that there's really no last leg for the Fed to stand on in terms of defending its posture on monetary stimulus at this point. So I do expect them to start to articulate a change in posture.
All right, so let's assume, Lisa, that happens. Later this month, Fed chair goes to Jackson Hole. He says what he does. He makes you think that the taper's coming sooner rather than later. The September meeting maybe puts that into play, and then October they start to taper. What does that mean for the market? Do we get all upset, or can we handle it?
Well, our base case really remains that what we're going to see is some announcements later in the year, with the beginning of tapering again near the end of the year and into early next year. But I think you certainly raise a good point that if there is expectations pulled forward that the Fed may really pull back on the gas pedal sooner than we expect, I do think that's going to affect markets. Certainly, markets have been dependent in recent years on, again, very accommodative stance, and any near-term pullback could affect and cause some volatility.
So, Greg, I'm thinking, if I believe what you say, that I want to be in the banks, and I'm a little weary of tech. Because, I mean, if rates are going to go up, I wonder what tech is going to do. And then if rates go up, the bank trade, which has worked, is going to keep working.
Right. Yeah, I think the bank trade will continue to work. What we saw is a multiple revision performance story. The multiples were crazy a year ago, right? Some of them trading less than tangible book. So that's no longer the trade. The trade is now earnings growth. There's an earnings growth story there, particularly with a more favorable net interest margin environment with rates coming up. Tech, I believe, will be a pause. I'm not necessarily pessimistic on tech because on the one hand, while you will have rates providing a headwind, On the other, the performance has just been spectacular. The narrative that what we saw over the last year was COVID pull-through or COVID-induced bumped has been summarily dismissed. And so, we're in the midst of an IT spending cycle, a hardware cycle with tremendous backlog. We're in the midst of a cloud transition to cloud cycle, seeing 50% growth in those businesses. So I think you have real secular tailwinds behind some of those tech stores.
All right, Lisa, what about positioning for you?
So our interest right now actually is in mid-cap stocks. So we advocate actually emphasizing that middle tier of capitalization for our clients. And really the reason why is mid-cap provides a very nice blend of both growth-oriented sectors as well as some cyclical exposure. So you're able to pick up on some of, again, the momentum we're seeing in the U.S. economy and reopening while still getting some measure of quality.
Hey, Greg, what do you make of this argument that some have made on the network, in fact, this week, that you're going to get an everything rally? The market's going to be able to handle what the Fed's going to do. It's already preparing for it. The bond market has moved up in anticipation, perhaps, of that and of the hotter than expected inflation read of the last couple of days. And then you're going to get beyond the Delta variant, and the cyclical stocks, some say, have bottomed. They're going to rise. And everything's going to go up once you just get past all of the fears about Delta, and the Fed does its thing. We're ready for everything.
Yeah, look, and at the highest level, I don't disagree that we're probably in a multi-year growth cycle. But I do quibble with the notion that everything will rise equally. There are going to be some sectors that are under tremendous cost pressure, whether that's food costs, whether that's input costs, or hard-to-find components costs. There are going to be some industries that are under tremendous inflationary wage pressures, and that's largely occurring at the mid to low end. And so what we're looking for are companies less prone to those threats, but again, that has secular tailwinds and a growth story that we can point at and articulate.
All right, you guys have a good day and a good weekend. We'll talk to you soon. Lisa and Greg, be well.
Thanks.